the purpose of today's session is we are going to focus and do a crash course of the 4 basic option strategies. So we'll talk about long calls, short calls, or covered calls rather, long puts, and then cash secured puts as well. So each individual option leg. We'll also talk about options pricing, and this is really 3 presentations put together. So it might be a lot if you've never learned about options before, but we'll also talk about the goal. The way that we teach this is it sets you up for even the Greeks. So if you have learned options before, or maybe you're newer to it, this refresher is designed to get you to the advanced stuff. So really hope this works for you. If you have, I see no video, it should be on, everything should be okay. If not, please let me know. Again, I might have some internet issues today. Nonetheless, let's go ahead and get started. Now, as always, have to give you a quick disclaimer. Know that this is purely for informational and educational purposes only. Options are complex. They're not necessarily for everyone. However, it always starts with financial literacy and education. Anything that I say is not intended to be personal financial advice. I don't know your personal financial situation. So therefore, this is not personal advice. It cannot be. It's not any individual tax, legal, or investment planning advice, just informational and educational purposes only. All right. And also, it's good to say the motto that we have formed for OptionsPlay education. Our intent is to empower you to trade sustainably and confidently. My personal life mission is around financial literacy, and that's why I joined OptionsPlay to bridge the investing gap. And because financial literacy is the crux of making empowering decisions. When you feel supported and you understand how things work, you make more informed decisions, and that's the intent of the OptionsPlay education arm that I work very closely with. All right. So let's get started. I'm going to minimize the Q&A. So if you have questions, you can pop them in the webinar chat. Can only see one at a time. So we'll start with what an option is. So an option is a contract between a buyer and a seller. If it sounds like legal jargon, it is literally because it is legal jargon. When you are you're the one purchasing the contract. And this is also where the terminology comes in. We call them options writers and options purchasers. When you're writing the contract or coming up with the terms, if you will, you're obligated to fulfill the other side. But when you're the seller in that case, if you're purchasing the contract, you own the execution terms because you're the one that's buying that contract. So you pay a premium for that. You are able to execute upon the terms of the contract. So that's the terminology there. An option is a contract between a buyer and a seller. The buyer pays a premium, therefore they own execution rights. The seller receives that premium. That's an upfront credit that they receive. Therefore, they're obligated to fulfill the other side of that contract. The analogy that we use all the time is we'll use strategy drivers. That's very important when we get to complex options and multi-leg options. But when we're thinking about options in the case of buyers versus sellers, the buyer is the driver. They're in the driver's seat. The seller is the passenger. They're in the passenger seat. The driver is the one that turns left or right, stops at the stop sign. The passenger is paying attention to their surroundings, but they're not the ones making the decision. A lot of times we get asked, how do I know if I get assigned early? So on and so forth. It all goes back to that analogy. So keep that one in mind as we go through this 101 course. The buyer is the driver, seller is the passenger. So the buyer has the execution rights. So in this example, the contract has some terms. That's 100 shares of ABC at $100 per share. It's executable at any time throughout that expiration period. So the buyer can go ahead and execute on those terms whenever they want. The buyer just has to fulfill the other side. The contract is issued as a call or a put. Back in my Series 7 days, the best way that I remembered this was call up, put down. Don't know why, very engraved in my mind. But a call just means it contains the right to buy, and the put means it contains the right to sell. If you've never learned options before, we say you focus on buying calls. We always look at everything through the lens of the buyer or through the lens of the driver of the strategy. So that's where we're going to focus mainly through the duration of this. I'm going to introduce you to each individual leg and the key items that you need to know that make you successful and the goals that are associated with it. But Simple terms, an option is simply a contract between a buyer and a seller. The buyer is in control of the terms of the contract. The seller just has to fulfill that. And of course, naturally, we'll expand on that. So moving on, the anatomy of an option. So whenever you have a contract, you have to answer some questions. What quantity are we agreeing on? What product are we agreeing on? What's the price? And what's the time frame? The quantity is just the contract amount. Generally, one contract equals 100 shares. I say generally because if there is an adjustment or of some sort, then those deliverables can absolutely shift. Then you get to do a little bit of algebra, and we can talk about stock splits if you'd like. But one contract generally represents 100 shares, and that's why we quote them by a per share price. The product is just the underlying security. There are lots of products that you can utilize options for these days. There are stocks, ETPs. We say ETPs because that's an exchange traded product, so that can cover an exchange traded fund or an exchange traded note, an index or indice, currency or commodity. You can't buy an index directly. You can buy an ETF that mirrors an index, but you can buy an option that gives you the right, per se, to purchase an index. And those are cash settled, and we can talk about that in a moment. But options give you a lot of diversity options, meaning you can utilize them with all sorts of products, all sorts of timeframes, and all sorts of prices, which can make it a little bit overwhelming, but we'll bring that together. So the price, that's just the strike price. You might hear that term before. That is just the price that you're agreeing to buy or sell the security at, and that is priced per share. The time frame is the expiration date. And it's normally on Fridays. And that's when options, it's so interesting to see how technology has really progressed, because when options were first introduced, they expired quarterly, and then it was every third Friday of the month. Now we have options expiring literally every single day as we see the rise of 0 DTE or 0 days till expiration options. So lots of options available for your options, pun completely intended. So the quantity represents one contract would equal 100 shares. The product in this example would be ABC. So ABC stock, its price would be $100 per share, and the expiration in this case, March 24th. And we're going to assume that's 30 days until expiration. So that means this contract represents 100 shares of ABC stock at $100 per share. And this contract is only good for the next 30 days until March 24th. And then it's issued as a call or a put, which again means, does it contain the right to buy or the right to sell? And when we're talking about options, we're always talking about it in the lens of the purchaser. It can be exercised. And remember, if you're buying, then you own the right to execute upon those terms. Can expire worthless. And that may be your intent, because if you're a buyer, you want it to go up in value as much as possible. So for example, if this contract were a call, and I owned the right to purchase 100 shares of ABC at any time through March 24th, that 30-day period. Well, if ABC, that contract's going to go up in value. If ABC is at 105, that contract has to be worth at least $5 because I own the right to buy ABC at $100 per share. That contract's going to go up in value even more. So if ABC is 110, then it's going to keep going up in value. And it can continuously do that, really, to an infinite price, because theoretically a stock can go to an infinite price. And so for the person who owns those execution rights, we want it to have as much value as possible. That's why we call it a sharp directional move. And we're going to go further into detail on that, but wanted to give you that example there. Put just is the other direction. That's why I say call up, put down. Could expire because it has an expiration date. I only own the right to purchase those shares through that period, kind of like a coupon. When it expires, I no longer can execute upon the terms of that contract because it was only for a specified period of time. Kind of like when you're buying a house for the first time and you agree to some terms, as soon as that expiration period goes away, you might have to get some new terms. Similar concept, not the same, similar. Or it could be traded on the market. You buy to open your contracts on purchasing. You sell to open if you are selling as your opening transaction. You can also buy to close or sell to close. And it's traded on the market for a premium, which represents the options price. So what is this option worth? Understanding options pricing is incredibly crucial to understanding pricing or options at all. Options are a derivative, which means it is derived from an underlying security. So in this case, we're talking equity options. So a stock, but again, it has all those other product types. But the underlying security is its derivative, but it only represents one pricing component. There are all these other factors that affect the options price. And if you understand that, that will help you understand the Greeks, but it also helps you understand the positive and negative factors, which leads into entry and exit and management. So pricing is arguably one of the most important components of options that you need to understand to lay that foundation and have those light bulb moments. I feel like I did. There we go. All right, so this is a T-chart. If you have never seen this before, I'm happy to walk you through it. We at OptionsPlay use this chart and build it out all the way to the Greeks. Once we have the Greeks built out, I call it our most stolen slide, which is totally fine because it helps you really break everything down. Now, I was first introduced to this back when I took my Series 7 over a decade ago, and won't give the year, but let me explain the structure to you. Calls are going to be on the left-hand side and puts on the right-hand side. We have bullish strategies on the top, and then bearish strategies are on the bottom. The way that this is structured is everything is essentially a mirror. Utilize this to figure everything else out. So when we have long options, what you'll notice here. So recall how I said calls represent the right to buy and puts the right to sell. There's some terminology that I just want you to have in your mind every time you see these words. So when you see long, that means purchased, calls, the right to buy, put, the right to sell. Short, same thing, just change it to sell. So you sold a call, you sold the right to buy, you sold a put, you sold the right to sell. And so if you keep that in mind, everything will click. So the long call will start here. I purchased that for a premium. I have a right to buy the underlying. I've purchased the right to buy, so I want it to go up in value as much as possible, which is why it's bullish on the top side. On the flip side, on the other hand, the short call, I sold the right to buy. And since I sold the right to buy, I'm obligated to fulfill the other side, which is sell the underlying. Someone's got to sell it to that person who is in the driver's side and says, hey, I want to buy 100 shares of ABC at $100. Well, if they want to buy it at $100, someone has to sell it to them. That execution is called exercising, and then subsequently assignment will occur to an offsetting short position, which is here. So they purchased for a premium, this person sold it for a premium, those two matched is the strategy we get. So therefore, the short call holder is bearish because they don't want them to execute upon the terms of that contract. They just want to keep that upfront premium. Therefore, they want it to expire worthless. That's when they realize their maximum gain potential. Puts are literally the opposite. So this is how we say it's a mirror. The long put, purchased for a premium. So I purchased the right to sell the underlying. I want it to go down as much as possible because if I have the right to sell 100 shares of ABC at $100 per share, that contract's going to be worth more the lower ABC is. On the flip side, if I sold that put or I sold the right to sell, I'm obligated to fulfill the other side, which is buy. I want that upfront premium. So I don't want the long put to start collecting value, which occurs when the underlying goes down. So that's why, since I don't want it to collect value, the short put is bullish. As ABC goes above that strike price, well, the market's going to be more favorable, as in selling at the market price is more favorable than the strike price as it goes up. That is why a short put is bullish. So you'll notice something in common with bullish and bearish strategies in regard to options. Bullish strategies contain a buy transaction of some sort, whether it's the right or the obligation. Bearish, a sell transaction of some sort, whether it is the right or the obligation. So great way to wrap your mind around it. Again, options can be complex. We layer these together, but we build on this chart. This is the crux of it. And the intent of showing you this chart in the beginning is it is essentially a mirror. And if you understand long calls and we focus on long calls, then you can figure everything else out. All right. So let's keep going. Good stuff. Still slideshow. Sorry, I can't see the. Is everything okay with the audio? Just wanted to check and moved everything around. Yes, cool, great. All right, so back to the presentation. So there are two different stocks. So we're going to take it back and understand the types of strategies I want to implement and why. So, and know that there is also value stocks and so on beyond that. But we're going to look at growth versus income. So when we have growth securities, I'm talking higher PE ratios, those price to earning ratios. They generally don't pay dividends. The company, when they have a profit, they have those earnings. They take those earnings and reinvest it back into the company for a better product. They innovate. Those tend to be your information technology companies. Amazon is a growth company. Google's a growth company. Microsoft, those are growth type of securities, even though some also pay dividends. Those are for the investors that are looking for capital appreciation. You're more looking for that upwards momentum. Whereas income securities, those that have those real dividend securities coming to mind instantly, AT&T, it's always just that huge dividend stock, notorious for their big dividend. Utility stocks, things like that, they don't generally take their capital and reinvest to innovate, but what they do is share a piece of their capital via dividends. So that's an income. They distribute their profits to you. So that's for the income-seeking investor, and generally they have lower PE ratios. When you have options, and when you're in an options course, I expect you to know this piece of the underlying security. You've got a good understanding of stocks so far, and now we're going to take that a step level and trade a product that's a derivative of that underlying security. And with options, you can be speculative or directional, or you can be on the income side, or we can also combine it all together. So I always like to show this and take it a step back with stocks when we add the layer on of options, because there are differences when we move from stocks to options. You're getting a contract that's going to give you the right to buy or sell. You own the contract, not the underlying security. So when you own a stock, you're usually looking for capital appreciation. It might be income as well, but you can get those dividends and you also get voting rights. You can hold that stock theoretically forever, and it could go up in value or it could not. You do not have that added layer of complexity. When we add on a stock or an option, you're adding an expiration date. Therefore, you have an added layer of complexity because that option is going to cease to exist at some point. Stocks don't cease to exist unless they go bankrupt. Even then, they'll end up in the OTC market with a 5-letter symbol and a Q that ends with it. So there are so many differences. Stocks do have different price influences. It's not just the security. We look at earnings, we look at revenue, we look at management, we could look at the technicals. They tend to have cost more for you to invest in it. Buying 100 shares of a stock is very capital intensive, whereas if you purchase an option, it does require less capital. You can purchase the right to buy or sell the obligation to buy to own the stock, but there's different risk to reward profiles. But options add a layer of complexity, and the asymmetrical risk profile tends to be very attractive to those looking to utilize options for the first time, but also the fact that you can utilize it as a leverage vehicle. So something to understand, but what I want those who are just venturing into options for the first time to consider is when you are analyzing a stock, you are understanding the internal and external factors that influence that stock. Internal is the company itself. External could be macro things like an interest rate environment. Whereas options, that is all true with the underlying security, but now we have to add on another layer, which is the options. And that's why we say it's increased complexity. Because of an expiration date, you have extra pricing components. And we've got to understand how that works. So why do we trade options? One, speculation. We have a investment thesis. We have a clear view. We say, all right, we are very bullish or we are very bearish, sharp directional moves. And the words I'm using set you up for the Greeks, so they're important to keep them there. Income. You might want to create yield on your portfolio because you can sell options. That selling is indicative of yield in this case. So we could utilize options to increase yield on our longer term portfolio. If you attend the Fidelity and the Money sessions, I tend to utilize those strategies quite often because it is a way to add options to enhance a current portfolio and still be rather conservative. You can be conservative or super aggressive with options. This is a way to utilize the conservative aspect with income. And hedging options, because it contains the right to sell, you can lock in a gain for a certain period of time because you have an expiration date. And it can protect your downside risk on your existing portfolio or positions. We have other sessions where we do beta weight calculations, and we went into a lot of detail. I did that one with you guys 2 months ago. So there is so much that options can use and that can enhance your portfolio. That layer of complexity, once you understand it, there are other pricing components, which means now if we understand them, we can enhance. And that leads to the crux of empowering you to trade options sustainably. It's informed decisions, but we have to be informed before we make those strategic decisions. All right, so speculative trading. These are purchasing options. Now recall how I said when you purchase, so we're long, we purchase the right to buy, we purchase the right to sell, you want the option to go up in value as much as possible. That's speculation. And this wording, it should be exactly or very, very close to what you'd find on the options application at your brokerage firm. When you are speculating, you are expecting a sharp directional move in your desired direction. We'll choose a call if it is upwards and a put if it is downwards. Simple. You own the right to buy or sell through the contract terms. You're just creating a right to buy or sell. Therefore, if you were purchasing the stock, you'd want it to go up so much. If you're shorting the stock, you want it to go down drastically, sharply. Sharp directional move is just what I want you to take away from that. Income trading is where we can have covered options. So we'll add a little bit of more complexity to something already complex to the conversation. This is where you can add yield to your existing portfolio, or you can utilize obligations to buy and sell stock. So a covered call, what does that mean? And we'll go into this a little more detail. But when I sell a call, remember, I'm obligated to fulfill the other side of the contract because I sold the right to buy. And if I sold the right to buy, I'm obligated to sell. I'm obligated to the other terms. That could have unlimited risk potential. So therefore, to cover that position, I just own the stock. If I'm obligated to sell, let me have something that I already own to sell you. That's why we say your shares are called away. And then the put just means the cash because you're obligated to buy. So what you need in order to purchase is the shares. Almost like a limit order is the way that I like to utilize that analogy. But you create an obligation to buy or sell through the contract terms, and you get an upfront premium. So that upfront premium can act as yield, but this is also how options traders utilize the contracts to buy and sell stock. Because you're creating an obligation to buy, you're creating an obligation to sell, and this is where strike price selection is extremely important, but we have to understand the components of options before we move to that level. And then last, and certainly not least, oh, and there's also more, but for what we're covering today is hedging. That's where you want to reduce risk on your overall portfolio. Perhaps you have a gain you want to protect, or you are trading a binary event of some sort. You could create the right to sell for a security that you already own, and that would lock in a profit for a certain period of time. And that's a version of hedging. You could also utilize a spread. There's other ways to do this, but it protects long-term profits or even short-term profits. Profits for any time frame for a specified time frame and reduces the risk of the overall portfolio, almost like you would buy insurance. I don't like to utilize that analogy because it opens up to different investment vehicles, but that essentially is what it is. All right, options pricing. So What's important to know here is how a premium is compressed. We know how a stock's price reacts. Now we have a derivative. What makes up an options price? And hopefully by now, and this is where we're going to focus on long calls, a premium is made up of two things, intrinsic value and extrinsic value. So the internal factors that affect the options premium, the extrinsic values, the things that are out of your control, essentially, as in you being the stock. Intrinsic value just means executable value, in the money value. There's lots of jargon and terminology in options, but it's just the way it is in finance. That means if a call, for example, if I own the right to buy 100 shares of ABC at $100 per share, I like to use $100, easy mental math, and ABC is at 105, it has to be worth at least $5 because I own the right to buy and my contract's more favorable than the market. That means it's in the money. It's in the money if your contract is more favorable than the market. And in the money only means long options. Is how we're looking at it through the lens of the person who is in the driver's seat. So long options. Short options can be in the money, but it's through the lens of the options purchaser. Extrinsic value is made up of two components, which is time value and implied volatility. This is applying some logic as well. So the more time you have until the option expires, or the more time the option has to gain executable value, the more expensive it's going to be. And that makes sense. An option that expires 30 days from now should be more expensive than an option that expires tomorrow, because that option that expires 30 days from now has more time to paying factor, something out of your control. As much as I would like to have a time machine, we do not. So therefore, that is a decaying factor. Now, implied volatility, the definition of that is the market's likelihood of the underlying security moving in either direction. So an anticipated movement of some sort is where that comes in. So again, it's the logic. Earnings is always a good example. If you have a underlying security or a stock that's about to report earnings, implied volatility spikes, because we know that that stock is going to move. So directional movement of some. So think about the definition. It's the market's anticipated move of the underlying in either direction. If we think it's going to move a lot, it has high implied volatility. And in earnings, there is a binary event. There is a date where we expect the stock to report, and it's going to hit or miss analyst expectations. We know that that's going to happen. And if it does, we know it's going to move a lot, mostly. And so that makes the options premium inflate because it's more likely to get executable value. So hopefully the takeaway from that is the things that affect the options premium are what could make it more valuable, which is stock movement, time, and events that increase implied volatility. Simple, right? Hopefully. And the way I like to remember that is intrinsic value is really internal factors that affect the options premium. Extrinsic is external factors that affect the options premium or price. And then just a quick example, if we've got ABC at $103 per share and we have a $100 strike 30 days till expiration call with a price of $5, let's do a little quick exercise to see what it's worth. So intrinsic value, this has some executable value, right? Because I own the right to buy 100 shares of ABC at $100 per share for the next 30 days, and I paid $5 for that right. Well, if I can buy ABC at $100 per share and ABC is at 103 per share, then the difference of those two is $3, because I could execute on the terms of that contract, buy ABC at $100 per share, immediately sell it at the market at 103. That's $3 worth of profit. Therefore, that option has to be worth at least $3. But it has the last price is $5 per share. So the excess ends up being the extrinsic value. See what I did there? So that's where the premium is comprised of, is internal factors and external factors. And remember, it could have no intrinsic value. It could just be extrinsic value. And if this was a very far out of the money option, so if ABC was at $80, the right to buy at $100 is considerably less valuable than the market, because I could buy ABC in the market at $80 per share. Therefore, that $100 strike price is going to be purely extrinsic value, and that's going to decay because time's going to move on. So that's where we need to understand how the option reacts to not only movement of the underlying, but time and these external events. All right, I feel like I'm going really slow, so we'll keep going. All right. So let's talk about long equity calls, and we'll go through each individual leg, what it's utilized for, and I'll give you an example. So when you were entering this into a trade ticket, this is the way that it's structured to look similar to a trade ticket. For long an equity call, remember, if we're long, we're purchasing. Equity just means stock. So we are purchasing a stock option, the right to buy the stock. So I'd buy to open one ABC call expiring on my expiration date at a strike price of $150 for $7. This means I own the right to buy 100 shares of ABC at $150 per share at any time through the expiration period, and I paid $7 for that. This is why we say it's a sharp directional move. I paid $7, so this is a profit and loss diagram that you're seeing here. The strike price here is $150. I need the underlying to move at expiration at least $7 to start collecting profit. That's why it needs a sharp directional move to be profitable and why you are speculative. So my max risk on this, though, whenever I'm purchasing options, I'm in the driver's seat and I own the right to execute upon the terms of contract, to buy or sell the stock. I don't have to do it if I don't want to. It doesn't always make sense. That means the most that I can lose is the amount that I paid for that contract. I don't have to exercise my contract if I don't want to. There is auto exercise, but you can stop that through a D&E or do not exercise. So you own that right. Therefore, that's your max risk. And that would occur if the stock doesn't move and it's not in line with your investment thesis or how you feel like the underlying security is going to move. Your break even occurs at expiration when it moves just as much as you paid for that right to buy, $7, and then your max gain is unlimited. Theoretically, stock can go to an infinite price, and if it moves above, then great, good job. But you could also see how if you have something like earnings, it's going to have a higher premium. You need it to move quite a bit. Therefore, we call that volatility crush. So lots can happen there. Long equity puts are literally have the same mechanisms. The direction is just different. Otherwise, it functions identical. We just want the stock to go down rather than up. So we still want a sharp directional move, just down. And you'll notice how that T-chart is a mirror, and this helps bring it all together. So if I were going to enter this in as a trade, my opening transaction would be buy to open, one ABC put expiring 30 days to expiration, the strike price of 150, let's say I bought 5 for this. And you'd say, well, why don't you use 7 there? Well, at OptionsPlay, and you may not know this, little peek behind the curtain, whenever we put these together, we actually normally use Apple, and then we normalize it for 100. And sometimes the call side will be more expensive than the put side. So these are always real stock prices or real options prices, but normalized for simple math and to be evergreen. Always fun to know those things. So same concept here, the direction is just different. And of course, there isn't unlimited gain potential because the stock can only go to 0. So in this case, my max loss is still the amount that I paid for the contract, which is $5 here. If it moves below $5 or the amount that I paid for the contract, I'm going to break even because I would own the right to sell at 150. Well, if I could buy at the market at 145, own the right to sell at 150, I made $5, but I paid $5. Therefore, we are break even. And then my max gain is substantial because as that stock declines below 145, that option is going to increase in value because the right to sell is becoming more favorable than the market. So very straightforward here. These are considered speculative options, and you are expecting a sharp directional move whenever you are purchasing options. That's why they are bullish. Now, when we start selling options, you are not expecting a sharp directional move. You are actually neutral with a slight directional bias, and I'll explain why. And so when we get into strategy, structure, and selection, when we are expecting sharp directional moves, we have to be very strategic with our structure and how much we pay for something. Whereas when we get to selling options, we look more at probabilities. We look at both, but the probabilities are more in your favor because you don't need so much of a move to be profitable. And I'll explain that further. So in order to create a covered call, this line right here represents you owning stock. When you own stock, you're going to lose value as the stock goes down in price, dollar for dollar, you're losing value. And you can, as the stock goes up in value, make an unlimited profit potential, right? When you are selling a call, you're creating an obligation to sell that stock. So this is the way that you can utilize options to enhance your longer term portfolio. So you would sell a call, creating an obligation to sell, utilizing the stock that you already have. You receive an upfront premium in this case, but what you're doing is you're capping your gain potential. With options, there is always a give and a take. Nothing life's free. So if I have my stock, my give is I'm going to get a premium. That's how I can add upfront yield to my portfolio. So let's say I purchased this stock at $90 per share. I'm selling a call that obligates me to sell my shares at $100 per share, and maybe I get $2 for that. I'm going to keep that $2 up front. And so think about that, the amount of capital that I spent. I purchased ABC at 90. I received $2. Now my capital spent is 88, and I created an obligation to sell at 100. So as the stock goes beyond 100, I've capped my gain potential. That's why this is a flat line here. And that's my max gain that I can receive. But it's also why strike price selection is extremely important. So in this case, the way that this works is when I own those shares, I'm creating yield on my portfolio. I'm reducing the capital that I spend. And when I'm reducing the capital that I spend, so again, that example, if I purchased it at 90, I received a premium of $2. That's what these two lines represent here. My break even went from 90 to 88. So I constantly, you can do this constantly and reduce your capital expense, reducing how much your break-even price very consistently. I still have substantial loss potential because I have stock owned and the stock could theoretically go to zero. But this is why it's neutral to bullish, because I don't want to be largely directional because I have a capped gain potential at whatever strike I choose. If I did expect a sharp directional move, this is not a strategy I'd want to deploy. But if I am seeking capital depreciation to a point, the strike price, and want to add income to my portfolio, then this would be a strategy that makes sense. Hence the covered call. The cash secured put has a identical profit and loss diagram. So the way that I'd create one is, one, I have to have the funds available. So what's the collateral required? I am obligated to buy the shares. Therefore, I must have the cash available to buy the shares, stock ETF in this case. You cannot create a cash secured put or a covered call on an index options because you can't buy those. So here I'm utilizing the cash as collateral. I receive that upfront premium, and now I have an obligation to buy the stock or ETF. And the same rules apply here. If the underlying security declines by the premium that I receive, then that's when I break even. And if it does decline, then I'm more likely or have a higher probability of owning that security. But it's a way that options traders utilize cash secured puts to buy stocks all too often. So this is where we build out the options T-chart to help you understand options. And the white space here is where we add the Greeks. So you'll notice that there are some goals attached now to each individual option leg. So when we have long options, when we purchase options, what I hope you took away from this is I am very directional. I want the stock to rally more or decline more, whatever my directional bias is, than the premium that I paid. So therefore, I want a sharp directional move. That's my goal for when I purchase options. And that time factor is negative because as time depletes, it also depletes the options premium, which means the option is going to go down in value. That's something that doesn't help me. Whereas if I sold options, I want a neutral movement and also have a slight directional bias. But as that option gets closer to expiration, it actually helps me because I sold the option to open. I could buy it to close at a lower price. That's my goal when I sold options individually. And then real quick, I added this slide because anytime I give this presentation, I get asked about the assignment process. I thought I'd bring it up one more time. When you are looking at the assignment process of an option, and a lot of times when we talk about covered calls and cash secured puts, but mainly covered calls, I always get asked that question. How do I know if I'm going to get assigned? And why is it always the next day? Well, this is why. The long option holder is in the driver's seat. They're the ones that are saying, I want to execute upon the terms of that contract. If they want to exercise, they have to submit those instructions to their brokerage firm. Normally, it is a phone call. Some firms can do it online. When they do that, the brokerage firm submits a notice to the OCC, which is the Options Clearing Corp. And then the OCC is going to randomly assign another broker. So if this was Fidelity, it may be Fidelity, it may be Charles Schwab, maybe E-Trade, maybe Merrill. It's just another broker with an offsetting position. And then that broker is going to receive that, and they're going to assign that to an options writer, or someone who sold that option, the offsetting position. And that could be random, or it could be a first in, first out basis. And fun fact, they have to have it on file with the OCC. And also you can find this normally in the disclosure somewhere through their exercise and assignment process if it is random or first in, first out. And so that is why you don't know until the next day and it shows up in your position account, is because it's an overnight process. It's not necessarily on your brokerage firm, and they have no idea if you have a covered call, a credit spread, or whatever strategy. They just know that you have a short call that looks like the long call that someone submitted exercise. And that's about it. I've got a lot of other statistics on here, but I think we've put it all together. So you'll definitely get a copy if you registered for the session and are on that free trial. You will get a copy of the slides to go through more. I will leave you with this one. This is a good statistic to understand, especially if you're trading options for the first time. It is very common to trade options on the market. 70% of options are traded on the market, not exercised. I've personally exercised an option twice in my life. There has been no reason to really do it because you can generally close them out on the market for its intrinsic value if you're getting to that place. And normally when you have an option at expiration, it's only worth its executable value. So holding an option till expiration equates to risk whether you're buying or selling. So important to know that. Only 7% are actually exercised and 23% expire worthless. Remember, that may be your goal. All right, so we covered most of it today. We hit time. Got about 5 minutes for questions. So if you have any, I'll check the Q&A, bring that back up, and then we'll go from there. All right, Giancarlo. If I sell a call or a put and the option does not get assigned at expiration or before, is the option still executed and the shares have to be either sold for a call or bought for puts? Yeah, it's very possible. So the way that the OCC works is, and I actually do believe I have a slide on it. Let's see. Oh, I leave the best practices up. That's important. So the OCC will automatically exercise an option if it is in the money by 1 penny or more on expiration, unless you submit counter instructions, which is a do not exercise. Normally, your brokerage firm will also take action if your account cannot support it, meaning they may close out your options for you. I've also seen them submit do not exercise for you, which you do not want. So therefore, that's also why holding an option till expiration equates to risk. But yes, it will be automatically exercised, which means short options are subsequently assigned. And if your account can't support it, your brokerage firm will do everything they can to make sure that that option does not exist in your account. So important to know. All right. Dura, if I sold a $15 covered call expiring April 26, 2024, and the call is in the money and the stock is $16 today, when is the best time to roll the covered calls and want to keep the stock? Is it okay to hold covered calls closer to expiration as time decay works in the favor? So, Dura, the only way to avoid assignment is by not holding the short call, first and foremost. As that option moves deeper in the money, so this one is $1 in the money because the short call contains the right to buy at 15, and if the stock is at 16, that's $1 in the money. That's a lower price security. So percentage-wise, that's actually quite a bit. If there is no time value or extrinsic value priced into that option, your probability of being assigned is very, very high. And if there's an ex-dividend date, it's also very, very high. So the closer that you hold until expiration, the more that time decay is going to kick in, which means you are more likely to get assigned. So hopefully that answers your question. If you want to keep the stock, you may want to buy to close it. And what will happen is, again, it should be worth at least $1 because that's how much it's in the money. If you buy to close it for $1 and some change, it evens out in a way because remember, you own the stock at 15. Now you have that value unrealized up until 16. So you get that capital appreciation on the stock that you own as well. You have to take that into account. Tamara asks a good question. If I own a stock at a much higher price than today, so losing the stock would result in a big loss, is a covered call advisable in this instance? So first and foremost, not financial advice, but if you have a big loss on a security, and this is not taking into account any tax considerations, selling a covered call will reduce the amount of capital that you spent. And if you do that over time, eventually you could get to break even. Now, when we get asked that question, or when I get asked that question, in your have capital set aside in that security, I would ask yourself, why did I buy this stock in the first place? And do I still believe that it's going to go up in value? Because it may make sense to move on to a different trade. Now, if there is income and dividends and other things associated with it, that's a different investment strategy. So that's what I would take into consideration. But a covered call strategy is a way to reduce the amount of money that I spent. You just be very strategic with the strike price that you select. So oftentimes when we talk about covered calls, our best practices is a 0.2 delta or something that's a little further away from the money, allowing you some room for capital appreciation. So if it does go up in value, you didn't handcuff yourself to a sell price. And then we look at normally 30 to 45 days until expiration. That way you get some of that time decay. Wayne. If you buy a put or sell a call, is that the same as shorting because you want the stock to go down? No, it is not. Selling a call in, well, I was putting them together. So in a way, selling a call is more similar because when you short a stock, you have unlimited risk potential. But the difference here is, so when you are shorting a stock, and also say it pays a dividend, you technically owe that to someone because you did borrow the stock from someone. That's the way Reg Show works. When you are selling a call and it's not covered, so I'm talking about a naked option here, you didn't borrow the stock from someone, so you don't owe those dividends, but you still retain the same unlimited risk potential. The difference is capital expenses here. Both are still very, very risky strategies. You could mitigate that risk, this is inclusive of a short stock too, by layering on options. So there's ways that we do that. So I definitely would say check out credit spreads or bear call spreads. Buying a put is very different than shorting a stock because of the risk there. If you buy a put, you own the right to sell. You don't have an unlimited risk potential. You have a much smaller risk potential than buying a put. So that's where I would weigh risk versus reward in those scenarios. Do we ever offer live in-person training? We used to do money shows and would have in-person representation. If that's something you ever want, I'd say send a message to info@optionsplay.com. It's something we can certainly take into consideration. Donato asks, what's my favorite strategy? Sure, I will entertain that. If I'm directional, I like a broken wing butterflies. So we can talk about those at some point. And for longer term portfolios, I sell puts to buy stock and sell cash, or so excuse me, sell covered calls once I own them. The wheel strategy on my longer term portfolio all the time. Sometimes the price of the stock goes up, but the option price goes down. Why? Well, that really depends on your strike price. And you could look at something called delta. So, delta is if the underlying security moves $1, how much does my option premium move? Because your option does not move dollar for dollar because of the implied volatility and the time value component. So if you have something very far out of the money, meaning you've got a long call on Apple, I don't even know where Apple is right now. It's at like 160 or something like that, maybe 180. Let's say it's 180. So say Apple's at 180, but you own a call at 200 and Apple rallies to 190. That call may not go up too much, especially if it had inflated implied volatility because of earnings and that came down. It may move up a lot and your option goes down. That's why pricing is extremely important. So for that answer there, 175. Thank you. I was close. I said 180. What does extrinsic value signal a sell or a buy? Well, so we would utilize implied volatility in that component. So we have a metric called implied volatility rank, or on your brokerage platform, you might see it as percentile or rank. That tells us if implied volatility is heightened. So that's a component of extrinsic value. If it is heightened, it means something is more expensive than usual. And if something's more expensive than usual, I want to sell the option. So that's how we would utilize extrinsic value to signal a sell or a buy. If it is lower, then it's considered cheap, quote unquote. Therefore, I would purchase. Daniel Green, if a stock closes at exactly $10, would any options $10 put or call be automatically exercised or no because neither is in the money by 1 penny? It would not because it's not in the money by 1 penny. However, that does not mean that it will not. So on the day of expiration, let's say, and this happened with Tesla many years ago on our exercise and assignment session, we talk about this, but we'll use $10 for your example. Say the stock closed at $10 and then you got someone who tweeted something and let me go back. You've got a call at $10 or even a put, and the stock at 4 p.m. closes at $10. So you're not in the money, either one. So you might have had a covered call or whatever. You'd say, okay, everything is fine. Say someone like Mr. Musk or whomever tweets something or some news comes out. Well, the OCC accepts exercise instructions until 5:30 p.m. Eastern time. So that is an hour and 30 minutes where you cannot trade that option because the market's closed, it expired, but you can still submit exercise instructions. So therefore, the person who holds that long option could exercise it. That's the only way they're going to get value, and then you would be assigned. So that's also another reason why you don't want to hold it until expiration. That is the surprise assignment risk, I like to call it. Very rare that it happens, but it happens with Tesla because it's a high beta security, high beta securities. That's very likely to happen. But great question. Would definitely do the money shows. Great. That. All right, I think we went through all of those. So thank you for the questions. We do cover the options wheel strategy in a webinar. We can certainly do that next. Next week, we're actually going to really flip the script and go right to advanced and do some earning strategies. So we'll talk about how to utilize options to price earnings. So as an analysis tool, as well as trade earnings. So if you want to see that, we will see you next week. Otherwise, I hope everyone has a wonderful evening and I will talk to you soon.